I'm guessing the academics have never met investors, right? Because investors are not rational people.
That's the best compliment I've gotten in days.
I guess you can fool some of the people all of the time, right?
All right, get on with it.
All right, everybody, welcome to Bugle Notes, where we sound off on the topics that we feel like our clients are interested in, that investors are interested in learning more about. So I'm Stephen Weitzel, managing partner at Reveille Wealth, and I'm joined today by Michael Bennicelli, who's our chief operating officer. Michael, you and I go way back
A little bit, yeah.
to our days at Georgia Tech. And so just kind of quick background about yourself, right? So you've been here with us for about 2 years in the COO role.
Yeah, it'll be 2 years, March. When did I start?
Middle of March? Yeah, March 15th, I think.
Yep.
But
Prior
just
to that, basically 15 years at Morgan Stanley. Actually started in Atlanta as part of a team, a financial advisor team as an analyst, kind of doing, all the stuff that you do as an analyst at the entry level, opening accounts, creating client reports, all that kind of stuff.
Yep.
Had an opportunity to move up to New York to work with Morgan Stanley in a home office role. So I did that April 2011. And then the time that I spent up there was really just all of the different parts of running a wealth management business. So I was part of the private wealth business. So, everything from technology and platforms to advisor compensation I kind of got exposed to all of it. So really interesting place to learn about the industry. So
absolutely. And the reason that you were such a great fit to come in and take on the COO role for us is that in the time that you had spent at Morgan up in New York, you understood the complete landscape of our industry, of our business, understood the nature of how we do things here, maybe how it's a little different. But today, what we want to talk about is really peeling back the onion for investors out there, or people who don't work in this industry, and give them some insight into how it works. Mm-hmm. And a lot of that is really incentive focused, in that, how do advisors get paid? How do firms make money?
Yep.
And maybe how that influences the advice or direction that they try to steer clients.
Yep.
And really just an evolution of the business as a whole. So
I think
let's just kind of start there.
Yeah, that's probably a good place to start. Is it helps to have a little bit of a history lesson on kind of how this industry evolved over time. Where I like to start this conversation is, if any of our listeners were investing back in the 80s or 90s, right, they probably worked with a stockbroker. They didn't really work with a financial advisor per se, right? And that broker's job was to sell them stocks or bonds, and they did it on a commission basis, right? So they charge per transaction.
Yep.
And that was really common up until probably what would you say, mid 90s, late 90s?
I'd say late 90s, even early 2000s, right, is when the shift away from the transaction oriented business model more towards the fee based,
right,
consulting thing. Yeah.
So the what's interesting is, if you look back at kind of the history, a lot of this was around what was profitable, the way that these firms were structured, and but the regulations that kind of govern how people invested and who they worked with have been around for a long time. So we all hold ourselves out as fiduciaries, right? We charge a fee for investment advice. And that structure has essentially been around since the Investment Advisors Act, which came out in
1940.
1940. Well done.
Yeah.
And that was really, what created what we know as a financial advisor, an FA today. So, I find it ironic that there's this, the term fiduciary is floating around right now, and people
like it's a novel concept. Right.
And it was literally created in the Investment Advisors Act of 1940. So, it's proof that marketing in this business is everything.
Correct. Yeah.
But, it's that idea, that concept, the idea of giving advice to clients and charging a fee for it has been around for a long time. It's just, it only really became, call it, the right thing to do, or where the industry is headed. Like you said, starting kind of in the, late 90s, 2000s. So, there still is a lot of transactional business that happens, of course, right? People
Sure.
still need to buy and sell stocks.
Yeah.
But I'd say largely the industry has kind of moved to this place of being financial planning and, so I guess tell me about, you coming up in the business and kind of how you learned, how you started, how your business has kind of transitioned over time. Let's talk a little bit about how we start and engage with a client around financial planning and, give a little insight there.
Yeah, and but before we get there, I want to mention one of the buzzwords now in the industry that really speaks to the evolution of the way that that the industry has engaged with clients, and it's the term democratized, right? That the idea of democratization is that there are things that clients are able to do for themselves.
Yeah.
And formerly, even back into the 90s, before E-Trade was a thing, or, what was one of the other early, I guess Schwab,
Yeah.
maybe TD Ameritrade, whenever those kind of came up and were a thing in the 90s when people were trading the internet stocks. Prior to that, you didn't have the ability to trade on your own as an investor. You had to go through an intermediary.
Sure.
You had to go through a broker-dealer to be able to purchase stocks, purchase bonds. And so you had to go to a professional, and they were going to charge you to be able to do that.
And a lot of it was really, it was because there was this information asymmetry, right? Your average person had no idea what the bid and ask on a stock was.
Correct.
No place they could look it up. And actually that kind of largely still exists in the bond market today.
It does. Well, and the other thing that most people probably don't know is that there are a bunch of different exchanges out there, right? It's not just the New York Stock Exchange, but you've got the Intercontinental Exchange, you got the Philadelphia Exchange, you got one in San Francisco, you have exchanges in Chicago, and there wasn't the instant price discovery, right, that somebody could theoretically have bought a stock on the Chicago Exchange for a much different price than what they could buy or sell it for in New York.
Yeah.
And so, as the information asymmetry has gone away, has eroded to where it's not just the professionals that know what's going on, and the clients have the ability to be able to trade for themselves, then our industry has had to move away from the role of we're going to be the ones that are going to fulfill the stocks that you want or the bonds that you want. Yeah. And they've been forced to move into more of the advice business, right? Where it's, it's one thing for you to be able to acquire Cisco stock or Apple stock or Bank of America or whatever it is, but should you actually be buying it right now?
Yeah.
Right.
So it's one thing I want to, we'll throw it up here for visual for the folks that are watching this recording. I actually, in doing a little bit of research for this, found a chart that shows the average commission per share on the New York Stock Exchange relative to the volume over time. And it kind of goes to what we were just talking about, the fact that it's gotten so much cheaper to actually trade stocks. And it's just because it's, the technology is there, it's quicker and easier to do.
Yep.
And to your comment earlier, right, this idea of democratization, it's anybody can do it on a platform online. So, most brokers today are even giving that service away for free.
Correct.
So, I don't know, the way I think about a lot of this stuff is As the business transitioned into a fee for advice model, really it's the right thing to do for clients, right? It's when you're buying and selling stocks for clients, you're doing on a commission basis, your incentives aren't necessarily aligned with the client, right?
No, definitely not.
So it makes a lot of sense that the industry went that direction, but the cynic in me, of course, looks at, a chart like this and says, it ceased to become profitable for these firms, so they had to go somewhere else, right?
Correct. Yep.
So,
well, and so to that end, and I want to get back to your question in just a minute in terms of just in the 17 years that I've been an advisor, what changes have I seen the industry undergo? But if we were to rewind 20 years or 30 years back when the industry largely was engaged in a lot of trading, the regulators at that point were looking for accounts that were being churned, right? That if every time a client got a phone call from their advisor, right? But at the time, you were their broker, right? That speaking of marketing, right? The transition of the title from broker to advisor to financial planner, wealth manager.
It'll be something else in a couple of years.
Correct. But back in the 80s and 90s, the regulators were concerned that the brokers had a misalignment of interest relative to their clients, that every time they picked up the phone to speak to their client, that they were going to solicit some sort of a change to the portfolio, whether or not it was needed, but that person was incentivized to effect a transaction because they were going to get paid probably to sell something and to buy something new. And so the firms would have to try to they would have to try to study how quickly are brokers turning these portfolios over, how many commissions are they charging, versus as we've gone to the fee-based type of business model where our industry now by and large charges a fee for advice, and whether they do 100 transactions or 10 transactions, they're going to get paid a certain amount.
Well, and it's funny that you go through that story, because the irony now is that regulators are actually looking at the opposite, right? So whereas they were concerned about advisors trading too much because they were trading just for the purpose of generating commissions, now they're concerned that an advisor is charging a fee and they're doing nothing.
Correct. Yeah, and so now the focus is on underutilization, right? And listen, I mean, we've heard it from just the time that we've been in the business and the time that you've seen kind of really in the behind the scenes operations of large wealth management firms, that advisors are using these platforms where they're charging a fee for the assets that they manage, and they may have a portfolio for their clients that's made up of mutual funds or ETFs or whatever it may be, and they change very little about what the clients own, and they'll even use the excuse of, well, the funds that we're invested in or the ETFs that we're invested in, they're making the changes underneath, and they will use they'll use the, I'm going to refer to it as an excuse, but they'll say, if I were to do something, if we were to sell something, then there's a tax consequence, right? And so they would start talking about things like the tax drag, and that's really become an excuse for, well, we really just shouldn't do anything. And so we really have gone a 180 from where advisors were flipping through all sorts of stocks and client accounts, doing transactions, generating commissions, to now they're largely just sitting on their hands because they know that they're going to get paid regardless.
Right.
And so, but I'll say this, and kind of getting back to the question that you asked in terms of what changes have I seen?
Sure.
That, early in my career is really when more advisors were adopting having more of a fee-based practice where they were going to be providing advice and doing financial planning versus trading, whether it's stocks, bonds, or whatever it was, for a commission, right? But what we've seen is that there's been fee compression, and now a lot of the fact that investors can access the market for free. There's no value to having a financial advisor put somebody in the market,
Right.
because investors can access the market for free. Now, what they need is advice as to, well, either what market should I be in, how much of each market should I be in, what's appropriate for me based on my own financial goals and objectives, what kind of portfolio do I need. And so that's where the industry has gone. But the one thing that I've seen really just in the last 5 years or so, getting back to this term democratized,
Yep.
is that a lot of the big firms out there, knowing that it now is there's no impediment for an investor to be able to access the market, now they have to offer something that is not democratized. And so there has been a major push into just maybe it started with the high end of private wealth, and it's making its way down just into more conventional wealth management, is that you need to look at something like an alternative investment.
Sure.
Right.
A ton of that out there. Yeah, that's in my time at Morgan, a lot of their focus on the alt side felt like they were trying to figure out how to make it more broadly available. That was, back in the day, it was something that only your wealthiest of wealthy clients could touch, right? Your private investments, hedge funds, all of those things. And,
Yep.
Now you could have $25,000 in an account and have some kind of access to
Potentially, right?
Traded products.
But so to your point, so let me ask this question. Why, and your comment was that these big firms, and we're not naming names because they all do it, right? That these are things that previously had barriers to entry where you had to have tens of millions of dollars to get into the space. But now they want to make them more widely available to their clients. And why is that? Why would they want these things all of a sudden that for years, decades, had only been available to their most exclusive clientele? Yeah. Why now would they want to make it more widely available?
Well, it's funny because, again, as I was preparing for this, I basically had 2 columns on the page of reasons for any of the things we're talking about. One of them is the, what's right for clients column, and the other column is me being the cynic, having been in this business long enough. And, the why it's a good thing for clients is because they're getting supposedly better returns or more consistent returns with less risk in the alternative.
Or they're just getting a different asset class, right? So maybe they're diversifying some, right?
Yeah, of course.
However,
the cynic, of course, is the fact that these things are expensive. You're able to charge a client, I don't know, for hedge funds, a lot of them are charging performance fees to where it's, 2% management fee and then 20% of the profits they make. It's insane. So,
well, and so they want to, or the firms are making these types of product offerings, if we refer to them that way, investment opportunities, however they might be couched or marketed. They're making these things more widely available because these are things still that have not yet really been, quote unquote, democratized. Sure. You can't do it by yourself. Mm-hmm. You can't go into an E-Trade account or a Schwab account and say, I'm going to put my money into this private equity firm, right? Or into this hedge fund.
But if you go to a large financial institution, they can pool all of your money together as a co-investment, and you can go into that fund with 100 of your closest buddies.
That's correct. So. But here's the interesting thing about this, though, right? So the way that these things work is that all of these big firms have effectively had, and whether it's a big notable hedge fund out there or private equity deal or real estate, they all get proprietary share classes that are created.
Right.
That, and what that means is you can't take it with you.
Right.
Okay, you cannot take it with you. That if you're at ABC firm and you buy into this big real estate investment or some big private equity investment firm through this company, that your money is going to be locked into that investment for 5 years, 8 years,
Sure.
something like that, and it is not portable.
Right.
If you decided, I no longer want to do business with this firm, you can make that determination for other pieces of your relationship. But this is something that you will not be able to move. But the firm that you're trying to get away from, they will still be making money from you with that investment that you have there until it matures, at which point you could maybe move on.
There you go.
And so we've seen a lot more advisory teams, I would say, especially in the private wealth space, that they have large percentages, or say larger percentages, of clients' investable assets in these alternative categories, right? What, maybe 25%, 30% of the client's investable assets go into these different alternatives. And again, the cynical nature of it is that regardless of how they perform, the advisors that are putting the client's money to work in these things, they're likely going to get paid up front to be able to do that. They're going to get paid a pretty sizable recurring revenue stream, and it cannot leave.
Yeah.
That regardless of how well or poorly they would treat their clients, if the client decides for whatever circumstance that they would prefer to do something else, they do not have an option for that. And so I would think that those are some of the reasons, maybe a little more cynical, but where you can have some misalignment of interests.
Absolutely. So I want to go back a second and talk about this kind of brokerage advisory history a little bit.
Yep.
And I again, doing a little bit of research to prepare for this. I talked a little while ago about how a lot of firms give regular trading away for free now, right? If you open an account at Schwab or at E-Trade or whatever else, you can essentially trade stocks for next to nothing, right? And we talked about kind of how we got to that point, right? It wasn't a profitable business. Information symmetry kind of went away, but another reason for it is that the structure of a lot of these large firms and how they make money has changed quite a bit over time. So, trivia question for you, right? I'm going to throw a number out there for you, and we're going to put this one up on the screen too. So,
Okay.
A lot of large financial institutions today make an outsized amount of their profits from what's known as net interest, right?
Yes.
So they're obviously charging or they are paying their clients some type of interest to have money in an account there, the cash that they hold, right?
Yep.
And they are turning around, they're lending that money out to whoever, right?
Margin or whatever, yeah.
So, and that's what banks do, right? There's nothing sinister about any of that. But I'm looking at a table. This is from Charles Schwab's 10K in 2022. I don't know why I didn't find 23, but What percentage of their total net income do you think came from net interest?
From net interest, I'm going to say, and so what are the other categories, right? Trading, is there advisory revenue or anything on there?
Fees, trading revenue, order flow, asset management fees, sure, all of that.
All right, I'm going to say, because I'm thinking it's a big number. I'm going to say 50%.
Close, 60%.
60%.
60%. Now, I'll caveat a little bit and say it was a little higher in that year than some other years, but they're probably averaging north of 50% of their income coming from
just from a spread.
So,
which is what they pay out, right? Or what they charge for margin loans or some less what they're paying.
Correct.
For a deposit.
So they're lending money. I think Charles Schwab, E-Trade, companies like that tend to lend to other large multinational corporations. They lend money to GE and GM and name the company, right? So, if you just look at the numbers, the incentive for a company like a Schwab or an E-Trade or really any company like that is that they just want to have as big of a pool of assets in-house as possible. So for them, the trading, sure, give it away for free. We're still going to take whatever cash that's not being used, however tiny little amount each individual client might have, that adds up to a ton.
Sure.
When you can turn it around and lend it out. So over the years, part of this, we'll call it a race to the bottom when it comes to commissions and stock trading, it's just purely been a play at how many assets can we gather? How can we get as much in the door as possible so that we can lend the money out?
And I think the other piece of it, aside from the lending, let's not be naive and think that all of a sudden that these firms that made so much money for so many years, charging some amount for executing a trade, even though that amount, has gone down a lot over time. I remember seeing the commercials back in the 90s and, maybe you could initially trade for, do a trade for $19.95 and then it was $9.95 and, it's just gone down and then now it's zero. Let's not think that these firms have gone or that they've eliminated commissions because all of a sudden, they're okay with not making any money. They still are going to make money when people trade, right? But most investors, or a lot of investors out there, may not realize that there are other ways that these firms make money from trading, right? I mean, you talked about something like order flow.
I mean, let's talk about Robin Hood, right? They made a whole movie, the GameStop saga and everything else, because they didn't make any money on stock trades. They made their money from payment for the order flow that they pushed to Citadel, right?
Yes,
to
the market makers,
correct?
Right?
Yeah.
And so here's the other thing that for people that are active traders, right? And again, that if somebody wants to short a stock, right? Whether it's an individual stock or an ETF or whatever it is, that if they're an active trader and they're gonna do something like shorting, even if you could make that trade for free for no commission, there are other fees that you have to pay. There are stock borrow fees,
which can be very expensive.
Which it's in the fine print of all of these account opening agreements, but those are not cheap. And so it's, hey, come over here and trade for free, right? Air quotes, trade for free. However, if you're a more sophisticated investor, or you're going to try to put on a more sophisticated trade, it may be options, it may be shorting, it may whatever. Don't think that these firms have just turned a benevolent leaf and they're going to allow you to be there for nothing. They are still making money. You may just not see it on the surface.
Sure. So I'm going to put you on the spot. There's a regulation that came out. It was relatively recently, within the past 5-10 years. I'm embarrassing myself. I don't remember exactly when. Known as Reg BI.
Yes. Best interest.
Best interest. There you
Yep. Okay. Did I pass?
Not yet.
Oh, that's not the question. Damn it. Okay.
Can you tell me in just general terms what that regulation is about?
My best guess, and as a certified financial planner,
Maybe
right, I would like to know.
Get yourself in
Yeah,
trouble.
I don't want to get in trouble with the CFP board here, but so Reg BI, as it affects us today, right? It means that we're having to that first of all, we should be putting the client's interests ahead of our interests, our financial interests,
Of course.
and that you have to make adequate disclosures to the client. And I think it's really more kind of along the lines of what we were talking about earlier, that this move of the industry to the fee-based accounts, that if you're going to move somebody into a fee-based account,
Yep.
you have to have a conversation with them and document that this is going to be in their best interest to move to an account where you're going to charge a fee, versus they may have been better off, or it may have been in their best interest if they sat in a commission-based account and were charged a commission to execute a trade,
Yeah.
if they were just going to hold it.
That's right. So, the oversimplification of the rule, but it's essentially a disclosure that you have to make to a client ahead of opening an account, any account. And essentially it's this brokerage versus advisory, right? Which one's more appropriate for the client? Because in your mind, you're thinking advisory account, charging a fee, my interests are aligned with the client, right? Their assets go up, my fee goes up, their assets go down, my fee goes down, right? All makes sense, but regulations, of course, are always chasing what's actually happening.
Correct.
And
They're always trying to solve yesterday's problem, right?
well said. So, obviously you've got these situations, and what the industry or the regulators within the industry are concerned about, or were concerned about, was that you have the unscrupulous advisor that puts a client into a fee-based account and doesn't do anything. So obviously the regulation, funny enough, is maybe brokerage is better, right? And it's funny to think that just the history of the industry and where we've come from and where we've gotten to, that the pendulum has gone so far the other direction that now the concern is we're charging a fee, we're not doing anything, right?
Correct. And I guess one of the, let's talk about one of the ways that as a self-regulatory industry, right, that the ways that, outside of monitoring to see how many transactions are actually occurring inside of these fee-based accounts, where they could say, hey, Mr. or Mrs. Advisor, you have, John and Jane Smith as clients, and you're charging them, some percentage to manage their assets, and there hasn't been a single trade in their account in 2 years, right? That, they can screen for those sorts of things, but the easiest way for a long time that they tried to identify whether or not these advisory relationships were being underutilized was if there was a lot of cash in these accounts. Right? And that was because interest rates were zero, and if you were charging a fee to hold cash, then the client was by default going to be losing money.
Right.
So they decided that you can't really have cash in those accounts, right?
Yep. I mean, that's, again, we talked about the regulation kind of chasing what's actually happening. If the concern was the account being underutilized, or you're charging a fee and not providing the advice, or not having some kind of strategy in the account, the firms putting these rules into place to try to prevent that from happening were pretty crude. It was, you know, you have to have a certain number of positions. You've got to have a minimal amount of cash in the account, because that definitely shows that you're doing your job, right?
If you're invested, you're doing your job, right? Or for the advisor, you better make sure your clients are invested, because if they're not, it looks like you're not doing your job.
Yeah, I hope everybody picked up on the sarcasm there.
Yeah.
So this is funny because we're getting into, you know, what I consider kind of the Reveille wealth management origin story here. So,
Yep.
you know, it's funny. I was thinking about the prepping for this a little bit. For whatever reason, the idea of the origin story movie came up in my mind, because it was a period in like 2000, or it was the 2000s, where like every movie that came out was some kind of origin story. It was Batman Begins, and it was, you know, the first James Bond Casino Royale, right? All these different movies that came out with that.
Christian Bale, probably, I think, the best Batman ever. I'm going with that. I don't think anybody touches him. Who's close to him?
I mean, that's a great question. Here's the thing: is you can't compare what he did with, you know, like Adam West, right? That's different.
Bam.
Genre,
right?
So,
but I'm going Christian Bale, best Batman ever, and Daniel Craig he's going to be a very close number 2 behind Sean Connery. Very close.
Unpopular opinion, but I was a huge Roger Moore fan. Maybe it's because the movies were pretty good. Like Live and Let Die is my favorite favorite James Bond movie.
Yep.
I don't know. So here's my question to you, right? We've got the Reveille Wealth Management origin story that we're going to talk about in a second. But let's just assume, you know, they're making our movie, which will happen pretty shortly, I think, right?
That's right.
We've already got a Warner Brothers contract.
That's right.
Yeah.
I'll be played by Leonardo DiCaprio.
That was going to be my question.
Yes.
Who plays you in the movie?
Yeah, Leonardo DiCaprio.
No chance.
Absolutely. Yeah.
So I get, let's see, I had somebody a while ago tell me that I look like Matt Damon, which I don't see, especially now. Stuff.
That's right.
But guess which one I get most often?
Of who your celebrity doppelganger is?
Ooh, I don't know if I want you to guess.
Wow.
that.
Yeah, you don't want me to say a name. I would.
Jason Statham.
Okay. Well,
Can you see that?
yeah, I can a little bit.
Yeah.
I
pulled up to we were going to a Georgia Tech football game. I'm pulling into the parking lot.
Yeah.
And I go to show my parking pass to the guy, and I start talking, and he says, "Holy crap, I expect you to have a British accent." That's the best compliment I've gotten in days.
I guess you can fool some of the people all of the time, right?
Anyway, so back to, you know, a bit of our origin story. So, you know, what we do at a high level, and I'll butcher it, so I'll let you, you know, go through this, is essentially we, you know, clients are in the market when we think the trends are favorable, things are heading the right direction. We take clients out of the market by asset class when things are trending the wrong direction.
Yep.
So invariably we can have large portions of cash in our portfolios, and we do.
Sure. Well, so I'll say that, you know, very quickly on the origin story. So, you and I graduated from Georgia Tech in 2006, and
Starting way back. Okay.
I'm going way back, and because we have to talk about the trauma first, right? That's where every good story is born, in the trauma. So we graduated in 2006, and I worked for Bank of America Investment Services and finished getting licensed, and became a minted financial advisor by the middle of 2007. Now, we can put up any chart that we want to. The middle of 2007 was probably not a great time to be entering into the wealth management business.
No, I would say not.
As a financial advisor, because
Then again, it would be worse if you had started before and had a bunch of assets.
well, true. However, I'll say this: as I was, getting started, we were all trained that and we studied a lot of this stuff in school, and modern portfolio theory and asset allocation and diversification and how you put together a portfolio, that I start in the industry, and you do exactly what they tell you you're supposed to do, right? You have discussions with clients about their financial planning and how you put together a portfolio for them. And very early on in my career, none of it worked, right? If you were doing exactly what you were supposed to be doing for a client, diversifying their assets and keeping them in some sort of asset allocation strategy, that there was nothing that was going to prevent that account from being down 40% in 2008. And luckily, fortunately, I was the only person in my training class who was not fired. And so I was able to hang on, stay in the business. And because at the depths of the financial crisis by early 2009, all these firms were just cleaning house, but so I knew very early on, like, look, there are as well-intentioned as the kind of the stock advice is, that there are times where it can go horribly wrong. Now, it may not happen very frequently, but when it does, it can be absolutely devastating. Yeah. And so what I recognized at that point in time was, look, there are times where the market's going to go down. The market's going to go down a lot. And would it not be better off? Would we not be better off for the clients if they just went and sat in cash for some period of time, right? And so that's where initially I start noodling around this idea of creating some sort of a strategy that would be adaptable to different market conditions, and knowing that protecting client assets or moving to the sideline during those big downturns was going to have material impacts for clients in terms of their long-term financial success, something that they can sleep with at night, right? Because the other side of this, all of the financial planning and asset management and all of the academic studies, right? There's one thing that they all presume, and it's rationality. It's that investors are rational people. I'm guessing the academics have never met investors, right? Because investors are not rational people. They're emotional people, and that's why people, they buy at the wrong time at the top, they sell at the wrong time at the bottom.
We've seen how many different studies done about, the average person trying to manage an account for themselves and how much they underperform if they use an advisor, and it's just because of the timing of what they're trying to do and the emotional
how much they underperform versus had they used an advisor. Is that what you mean?
Correct.
Yeah, there you go. But so I'll digress. The origin story of Reveille is built in that trauma, or founded in that trauma that I experienced early on in my career, of saying these industry standard solutions, if somebody has the stomach to do this for a long time, to hang in there and withstand massive declines, then they can be successful in the accumulation phase, right? But you imagine somebody's retired and they face a 40% decline and they're spending, that person never recovers.
Right.
And so I just knew there had to be a better way out there. And so fast forward to the Reveille story and the rules-based investment discipline that can be flexible with the allocations that we have, or market exposure that we have based on the market conditions we're experiencing. And the industry, by and large, would say, well, we're never going to adopt something like that if not for scalability reasons. But the other piece of it, and a little more sinister, a misalignment of interests, that if the way that a lot of these advisory platforms are designed is to say the advisor isn't going to get paid if you go sit in cash.
Well, yeah, this is, what we talked about in the evolution of the regulations and the policies in this industry. And it's, as we transitioned as a business from being largely brokerage to largely fee-based advisory, the concern being the advisor's not doing their job, but they're still charging a fee. The rules that were put in place were, you had to have a certain number of positions in an account and a minimal amount of cash, and that was monitored. And so if you think about the incentives and the misalignment, it was born out of this, regulation and policy that came along with this transition, trying to do the right thing.
Correct. Well, so the firms were trying to, and you can speak to this more than I can, right? Because you were part of the apparatus, running this type of thing at Morgan Stanley, right? That the rule sets that they put in to try to govern and monitor this, they have to try to come up with something that they can try to X-ray down scalably,
right? To
say, we're trying to screen to uncover where there might be underutilization, right? And even though it may be missing the mark, right, that's still their best way to be able to approximate what they think they're looking for.
Yeah.
Is that right?
It's always been an issue in that any financial firm has to have policies in place that enforce the regulations that are out there, right? And the policies have to be able to be broadly applied, right? So, if the regulation is that FINRA or the SEC or whatever regulatory body wants to make sure that there is a legitimate investment strategy being followed in one of these advisory accounts where you're charging a fee, well, how the hell do you put a policy in place that says that you have an investment strategy, right? So to be able to scale that type of regulation, to be able to monitor across thousands and thousands of advisors, you've got to have some cut and dry, numbers-based policies that they can follow, and that's where a lot of it came from. So, but again, it's a misalignment of interest when your advisory policy says that you have to be invested all the time. Otherwise, you're not going to get paid. Right?
Correct. And so the advisors are not going to, even if they believe it would be in the best interest of their client for the short run, okay? I'm not talking about forever, but if somebody thought that or had a very good sense that the market was going to drop precipitously, right, that they would only exit to a certain extent if they knew that their compensation would be diminished as a result of their action, right? So I got two other things here, and then we'll move on. So for this reason, and because actually monitoring all of these advisors, you think about the big firms out there. I don't know how many advisors are still at Merrill. I think Morgan Stanley had like 18,000 advisors. Is that right?
15, 16, I think. Something like that.
So
big number.
Lots of advisors, and there has been a big pull, let's call it, over the last decade or so, to try to disincentivize the advisors from actually managing the money on their own, and they just want everybody to use the firm models, right?
Safer that way.
It's safer for them that way, right? Because they obviously don't want some rogue advisor out there. But if they had more people that are leveraging these firm models, then they only have, as long as they know that they have an investment committee that's making, these changes, that they can pass it all off as being suitable.
Yeah.
Right.
Yeah. All right. So I think we've probably sufficiently beat this topic to death. So why don't we try to close it out here a little bit? But
Yep.
I guess I just want to say, first of all, I think, or I hope everybody listening got a little bit out of this, learned a little bit about how this industry works, kind of where the incentives lie, so they have the ability to question when they're looking at hiring a financial advisor.
Sure.
Just so that they're a little more educated. But
well, to that end, right? If one of the efforts that we always want to try to make is to be transparent,
absolutely,
with people, that the more information that we can arm people with, to where they can make the most informed decision they possibly can, and that's the intention behind all of it.
That's right. And I think I hope it also lends some insight into really how we run our business here, which is, the business was founded on the idea of questioning the way that things are traditionally done, right?
Yes.
And you went through, the origin story and kind of how you came to that realization, but we try to apply that to really every aspect of how we think, not necessarily just the investments, but how we run the business as a whole and how, things should be done. So
the status quo, can be challenged, right? And it can be improved upon.
That's right.
Yeah.
All right. Well, let's close it out. But before we do, we are recording this a couple of days before the Super Bowl. Who knows when it'll come out, but we're going to make some
Super Bowl? Yeah, that's this Sunday.
Yeah. Who knows when the podcast will come out?
Yes.
So we're going to make some Super Bowl picks and hopefully not embarrass ourselves. But
yeah,
what do you think? First of all, I'm disappointed with who's in the Super Bowl. But
yes,
the last two games they couldn't have gone any worse than they did. So
yeah, I mean Baltimore
blew it.
They blew it big time, right? And I guess there was a lesson in karma there for Zay Flowers, that he gets that penalty that sets him back, but he's got an opportunity to score, and he fumbles going, before he gets to the goal line.
Game inches, man.
And so I was I was hoping that Baltimore would actually make it, because they've been such a great team all season.
Yeah. And your fan favorite Lions are not in either.
Yes, I was really hoping to. Now, of course, as a Georgia Tech faithful here, right? I was pulling for the Lions because I wanted to see Jahmyr Gibbs.
There you go.
Make it in, and so it was a little bit of a heartbreaker. But I'll say I don't know how I want the Super Bowl to work out here, because we have Harrison Butker, Georgia Tech alum, is the kicker for the Chiefs, right? And then we got Jordan Mason, who is Georgia Tech running back, who is a backup to Christian McCaffrey for the 49ers. So I don't necessarily know how I want it to come out.
You're basing your picks purely on Georgia Tech alumni. Got it.
Well, if I know that I'm balanced in terms of I've got an equal number of players on each roster, so you tell me what are you thinking, and then I'll tell you who I would like and maybe what we think the score is.
So I'll tell you what, I gained a little more respect for Patrick Mahomes after last game because he got the crap kicked out of him and he kept getting back up and played pretty exceptional considering. They didn't have the offense they normally do, but he was like 30 for 39. I mean,
was he really in the Baltimore game?
Absolutely.
Wow. Yeah, I missed part of that because I was at a skating rink for a birthday party. Right.
So anyway, I think he's going to do his thing, but I really do think San Francisco's going to win, and I think it's because their defense is pretty monstrous. Kansas City's defense has been great all year, but I think San Francisco.
So I'd say this: the surprise to me through the playoffs was Kansas City's defense. I thought
they're well all year.
But I feel like they've obviously with Mahomes they get so much credit on the offensive side of the ball, right?
Yeah.
And they've got a lot of weapons, obviously Kelsey, right? But Edwards-Helaire and
come on, make a pick.
So I don't know. I'm gonna say this. I'm gonna take San Francisco as well.
I'll go San Francisco 27, 24.
Okay, I'm gonna go. I'm gonna go San Francisco, 28, 21.
Okay, we'll see what happens.
So,
All right.
Well, listen. Thanks everybody for tuning in. I really appreciate it. And if there's anything that you'd like for us to talk about on some of these other podcasts, feel free to drop us a note to info@reveillewealth.com. But for Michael Bennicelli, Stephen Weitzel signing off.